Let's inject some scepticism. What are the main risks to this outlook that Powell gave us yesterday?
Look, I think Jay Powell is looking through the economy right now just beyond numbers. And as we were just discussing, the economy seems to be split into two parts right now. One part of the economy is on the top end, which we call the Taylor Swift economy, where people can buy tickets from $9,000, $10,000 just to see one show. And that economy, that end of the economy is driving travel, tourism, hospitality, high-end restaurants, high-end retailing, and so on. Then there is the other end of the economy, which is the average Joe economy, which is not doing so well. You can see Dollar Tree announcing 100 retail stores closing when all the luxury brands announced 400 new stores opening in the same time. And there you can see credit card debt being raked up, delinquencies rising on both credit cards and auto loans, layoffs across industry now. It's not just a tech story. Job openings are coming down. Quit rates have come down. So I think the Fed is now conscious that a very large part of the economy may have risks in that. By keeping monetary policy tight for too long may not be all that good.
But the Fed boosted its growth forecasts through 2026. Yes. So when you balance those two sides of the coin, which one weighs more heavily? Do you still see the chance of a recession in the US?
No, I think the chances of recession are ruled out. I think I would give credit to the Fed saying that finally we've probably achieved something which is very rare, which is a soft landing. We may see mild slowdown of the economy for sure getting into this year, but a recession is pretty much ruled out. Look, recession is not also a mandate which the Fed has. Fed's mandate is to keep the economy strong and bring down the inflation. And data underneath is showing that.
And one for the nerds. It seems like the view of R star on the FOMC has increased, the neutral rate. Do you agree with that?
Oh yes, absolutely. I think the economy, the way it's structured today, is not the same as it was structured in the 70s or 80s or 90s. So the whole concept of what is a neutral rate, what is the best possible inflation levels, is it really 2% or is it more than 2%? Those debates have come back. And therefore, neutral rates could be much higher than where the very difficult to say, but higher than where they are, given the services-oriented and focused economy that we've got into. Very clearly, about 80% of the economy is driven by that.
OK, so you've got the Fed cuts powering the S&P rally, but it's also the enthusiasm about tech, about AI. Is that bubble about to burst?
Well, I think it's just the beginning of a long-term secular bull story which is building up. It's once in a generation. I think we are at the cusp of the fourth industrial revolution. It may sound very cliched, but yeah, it is. I think the last time we saw these revolutions, industrial revolutions, they tend to last for 20, 30 years, whether it was the steam engines in the 1800s or electricity in 1900 or computers in the 60s and 70s. So I think we are at the cusp of that. And artificial intelligence is a catalyst which the stocks have got after a very long time, a generational catalyst which now looks beyond the monetary policy, the economic growth, and the data and so on. So the markets are looking beyond that.
OK, so the opposite view of Cathie Wood.
Yes.
With that in mind, is there no need to worry about diversifying away from tech?
Look, the whole market is concentrated towards that, and more money is flowing into it.
Is that healthy?
It may not be. It's not good for the capital markets because entrepreneurs across the industries need to raise capital, whether it is debt or equity. And if all the capital follows only one sector, it may not be healthy. But the good thing is, and the sweet spot which is coming up is that it's not a technology play alone. AI is now diffusing across industries. And therefore, that diffusion will bring in capital for other industries as well. So you can already see in beauty, in healthcare, in manufacturing, in education, and so on. So AI is just about starting to diffuse. And that's where the capital will follow. OK,
so the wave that lifts all boats. Let's just get back to central banks because, as I say, it's a central bank bonanza today.
Yes.
Where are the opportunities for you in fixed income in light of all of this shifting?
I think huge opportunities. You're still seeing yields which will be dream yields 2 years down the road. So investors are advised to lock in high yields with high-quality debt. There is no point going into high-yield or emerging markets at this stage. Go for investment grade and lock in returns for the long duration. These yields are not going to come back.